Ed, I want to talk to you about your recent product launch here after months and months of discussion. American Century, you guys became the first fund to launch what do we call them, I guess now ANTS, active non-transparent ETFs. You launched American Century Dynamic Growth, American Century Large Cap Value, two of these funds last week. I want to remind everyone, unlike most ETFs, these ANTs do not reveal their holdings on a daily basis, and that's the major point here. Ed, congrats. You look like you're the first one out of the gate on this one. Tell us about these two funds and how they are trading. I mean, they only started just towards the end of last week, right?
Yeah, so let me jump into how they're trading first. I mean, they've been trading well, quite honestly, right off the bat. If you look at the products themselves, we're talking about, the first day, they each traded over 100,000 shares each. And spreads have been at a good level, 23 to 26 basis points since they've launched. Friday, they each traded reasonably well as well. And the nice part about this is spreads have maintained. There's been investor interest as they slowly get up on platforms. And so we've been buying. People have been buying. For Focused Dynamic Growth, it's a concentrated large cap value portfolio. So it's going to own, call it 40 to 60 stocks, and its expense ratio is going to be 45 basis points. For the Focused Large Value, go ahead, I'm sorry, please.
Go ahead, finish your point.
I was going to say Focused Large Value is the same type of concentration, 40 to 60 securities, and that one's going to be priced at 42 basis points. And again, it's looking for value out there, looking for stocks that can lean towards a higher alpha portfolio while they're concentrated.
Yeah. And the key point is there is a sort of mirror fund for these. You have a mutual fund that essentially owns all of these as well. In this case, it's simply an ETF platform that you have out there, but there is an actively managed mutual fund that's sort of the mirror of these as well. Is that a fair way to describe it?
For Focused Dynamic Growth, it's hard to call it a mirror, but yes, there's a very similar strategy. The fund itself will own different things because it owns international, while the ETF, this construct, the SEC hasn't approved any international holdings at the moment, so it's going to be a little bit different, but similar in strategy. For large value, we don't have a fund that's targeted towards this. So it's a newer strategy, so that one's going to be a little bit different.
So, John, let me just sort of move on about the whole philosophical point about ANTS, the fact that they are essentially active fund managers in a mutual fund space are migrating or at least moving over to the ETF space. And I guess, John, is this the last stand for active management? We all know they've had a very rough time of it for almost the last decade. Will a large portion, do you think, of actively managed mutual funds eventually migrate to an ETF space?
There's a good chance, a good probability that occurs. I mean, I think a lot of those mutual funds that were bought, years and years ago, they're not sitting on embedded gains anymore, most likely. So I think now would be the opportunity for, a financial advisor to sell their, actively managed mutual fund to buy, let's say, an ANT product. I kudos to American Century for being first to market. That's usually what you want to do. I think that, for my money, we prefer a little bit more transparency than less in general. But I'm always amazed about the ETF product. I've been working in the ETF ecosystem for 20 years. I remember when iShares first launched 25 ETFs in one day, people were like, why do you need a single country? Why do you need a subsector ETF? And sure enough, we have an entire industry now. So, there's always a market. And, what I would say is that, if what you saw in the last month is just the dominant force in terms of, being able to kind of, be more forward-looking, price discovery, true indicator of what the net asset value is. I think the mutual fund industry is in trouble, obviously. Just my whole business is based on the ETF ecosystem. So we're pulling for Ed and his team.
Yeah. So, Ed, do you have I don't know if it's a fair question, but do you have a horse in this race? Does it matter to you whether the mutual fund platform migrates over to the ETF space or not? I mean, how does the industry feel about this overall?
I mean, from our perspective, we want to offer the investors choice, right? So there are clients who are going to prefer mutual funds. It's just their normal habit, whether it's been dollar cost averaging or 401ks or 529s. There are other investors who want more control. And those are the investors that we're going to be targeting, right? And so for us, we want to make sure we give the investor the choice of vehicle that they want to use. And if you look across, there are a lot of advisors who are starting to prefer ETFs more and more for the flexibility and the benefits they offer, whether it's tax efficiency or whether it's trading intraday. And so the other thing you'll notice, Bob, is what's been happening with the headlines is ETFs are beginning to look more and more like mutual funds, whether it's platforms waiving commissions or allowing fractional shares. So there's going to be a point where they become a level playing field, and ETFs with their benefits could outweigh those of mutual funds in the long term.
Right, and here we see the holdings. Now you don't publish because they're not disclosed every day. We don't know what's in the ETF, but this is what's in the big holdings that are in the mutual fund, right? And it looks like standard growth stocks here. But just tell me what the cost is, by the way. What's the cost of owning the mutual fund versus the ETF?
So the lowest share class we have on the mutual fund is 65 basis points for focused dynamic growth. For the ETF, it's 45.
Okay, so it's at least 20 basis points lower. And they don't, the top 10 come out monthly, is that right? I'm just trying to figure out now how often we will find out what's in these funds. The top 10 come out monthly?
So the top 10 will come out monthly, and they're a large percentage of the holdings, so you'll be able to see those. Because the first seeding date, which is the official date, was March 31st, we'll be able to see the actual fund holdings for both 15 days after quarter end, which will be the old tax day, April 15th. The other thing, Bob, I do want to point out, which is interesting, is I was checking with some of the main websites that publish the holdings of every ETF and asked them what percentage of people that visit the site actually look at the holdings, and it's way lower than I anticipated. They said it was only 15%. So if you eliminate the people that really look for holdings, this is just an ETF to everyone else.
Right, I know. That's the argument. People don't really care that much, but I think a lot of people do here. John, I'm wondering how much pressure these ants, so-called ants, are going to put on the fund industry as a whole. So if ants become big and a lot of active mutual fund managers migrate to the ETF space where there are lower fees, I mean, these higher fees mutual funds pay for a lot of businesses. They pay for a lot of platforms that are out there. If all of a sudden the overall amount of revenues taken in, the fee structure drops for the whole industry, isn't that going to put some pressure on the fund families and the people who run this stuff in general? I'm trying to think of the consequences of this if it becomes successful down the road.
I mean, I think the market is already pricing that in, Bob. If you look at the PE ratios for a lot of the actively managed mutual fund complexes, I mean, single-digit PE ratios, and it's been that way for a number of years. So I think the market is telling the mutual fund industry, like, hey, you need to get on the ball here and, get involved in the ETF ecosystem in one shape or form, and ANTS is one way to do it. I do think that you're going to need distribution and performance, for that product to raise assets. So you'll kind of know what type of firm you have if you are able to successfully raise assets, because I don't think anyone's going to buy it unless you either have strong distribution or really good performance. So those two, I think, are the crucial things.
Well, Ed, you're in this business for a long time. You've been in the mutual fund business as well. Do you understand what I'm saying? If this is successful, what if you get wildly successful and active fund managers go to the ETF space, overall fees are going to come down. I'm just talking philosophically. Those high fee mutual funds pay for a lot of things, pay for a lot of platforms that are out there. Is there going to be an impact as a result if they become really successful?
Well, I think everyone's going to have to relook at eventually, if these are super successful, business models. And I don't mean just the mutual fund companies themselves. I mean all of the platforms that the mutual funds are on. The ETFs themselves, if they become highly successful, it predicates, one, client's choice, but two, you're not necessarily repricing a business, because ETFs are very different when you look at how much they cost to run across the board versus a mutual fund. So those differences have to be taken into account, because the clients that prefer the mutual fund may just need that structure for certain things. But you are right in the one aspect, whereas platforms and sponsors will have to relook at everything as time goes on if these are highly successful, which our hope is obviously they will be.
Yeah, I think it's a good example. Be careful what you wish for. I hope they will be successful, but I can't help but think if they are, 65 basis points versus 45, and I think I think there could be a lot bigger differences, and that's going to have an impact.